What are types of financial statements frauds? There are different forms of financial statement fraud that companies might commit. Here are 3 of the most common types of financial statement fraud to be on the alert for. The 3 most common types of financial statement fraud. 1. Overstating revenue. Probably the most common financial statement fraud is the manipulation of sales, revenue, figures. It's in the company's best interest to report higher sales, as opposed to lower sales, so virtually every company runs the risk of overstating sales. In some industries, it's very clear when a sale has occurred. If a customer enters a retail store and purchases an item from a cashier, there is a little doubt that a sale has occurred. In many businesses and industries, however, it's not so straightforward, and there is some gray area when it comes to deciding when a sale has occurred. Consider the insurance industry. You pay your insurance premium in advance of receiving your policy. Money has changed hands, but the insurance company can't record revenue yet because the company hasn't yet done anything to earn that money. Calculations must be done to determine what revenue has actually been earned during the accounting period. Revenue overstatement can also occur in a very straightforward fashion through booking revenue for sales that have not occurred. In this case, there is no gray area. This situation might include booking a completely fictitious sale. 2. Overstating assets. Asset accounts are manipulated to enhance a company's balance sheet, especially to positively impact important ratios involving assets. At higher risk of overstatement are current assets such as accounts receivable. Companies don't always like to write down or reserve for outstanding balances that customers aren't going to pay. Yet the accounting rules require these write-downs to be done when management is aware that an account is uncollectible. Failing to make these write-offs in a timely fashion is financial statement fraud, plain and simple. But it's often done because it's easy to get away with. There can be a high level of activity in the area of accounts receivable, so auditors aren't very likely to detect. And if the manipulations are discovered, it's easy for management to claim that they weren't aware that an account should be written off or they weren't aware that it was a long overdue. Other ways to commit financial statement fraud related to assets include failing to write down assets with impaired values, such as goodwill or other intangible assets, failing to write down obsolete inventory, or failing to record expenses for accounts with collection problems. 3. Understating expenses. One surefire way to increase companies' profits and enhance the financial statements is by not booking expenses as the company incurs them. The manipulation of expenses can be very simple. Management can hold expenses and wait to book them until future periods. Another option is improperly capitalizing the expenses instead of immediately booking them to the profit and loss statement. Looking to fund your business? Better call Sal. If you learned something from this video, write "Better Call Sal" in the comments. And don't forget to like and subscribe.